From a high-level perspective, the methodology behind calculating savings is actually pretty simple. You take your baseline case, you subtract out the projected case, and the delta between those two, or the difference, is your savings. Now, obviously, I've made that sound deceptively simple. The devil really is in the details, and we'll discuss all of those details. But for now, I'd just like to emphasize that when you're doing that calculation, the importance of doing so in a so-called open book manner versus a closed book manner. And what I mean by that is that when you're doing that calculation, you really need to show all of your assumptions, and you need to show how you arrived at your final numbers. And you have to do that because, keep in mind, as you already know, your work is going to be reviewed by an independent third-party reviewer. And in order for that person to do that, they'll have to see exactly how you came up with your conclusions. Essentially, they're going to check your math. So you need to do that in an open book manner. The most common question I get is, what can I count as savings? What can be counted as savings? And the overarching principle is that you can count something as savings if it has a demonstrable cash benefit. Now, the most obvious one of those is going to be a reduction in utility bills, right? So you do the project, and the facility's energy or water consumption or utility bill is going to go down. That's a cash benefit, so that definitely could count as savings. Beyond that, there's a number of other things that you could count as savings. The first one is the value of any produced energy. So, for example, a production-based incentive, or perhaps a net metering, perhaps revenue from a PPA. The next one is tax savings, and in the form of tax credits or depreciation, accelerated depreciation. The one caveat to keep in mind is that in order to claim tax savings, there has to be a tax liability associated with the entity that's going to take those savings, right? Because there has to be a cash benefit. So in general, nonprofits are not going to be able to take advantage of tax savings, or other smaller businesses that might not have a tax liability. Rebates count as savings. You're still going to be bound by the rules of whatever the particular utility's rebate program are. But certainly you could count the rebates as savings. And then finally, operational or maintenance savings. In general, we discourage those just because they're so difficult to justify sometimes. But if you really can show a history of outsized maintenance costs that will largely be diminished as a result of the project, then in some cases you could count the maintenance savings as well. What cannot be counted as savings? And it goes back to this idea of it has to have a demonstrable cash benefit in order to count as savings. The first one I hear a lot is staff time. So if you've got someone on staff who is not going to have to do some particular type of maintenance or activity or operational activity as much as they would have after the project, and they're just going to be shifted to other duties, you really can't count that as savings because they're still incurring that staff cost. The other one I hear a lot is this idea of capital cost avoidance, or I've heard it called deferred or avoided CapEx, and that really can't be counted as savings either. And the reason for that is because doing that analysis is essentially just comparing the same project using different financing methods, whether it's capital out of pocket or using PACE financing. And the reason it's inappropriate is because you end up with a blended baseline where you're claiming savings both from doing the project and in savings from the financing cost. And that really is just not an appropriate way to model savings from these projects. At the end of the analysis, there are two main outcomes that we're ultimately looking for. The first is on the savings side, and that will be in the form of a savings summary. We'll need to know what are the improvements, what are the measures. We'll want to know what are their utility savings, not in dollars, but in their respective utility unit. We'll want to know what are the utility rates that go into calculating the cost and the savings. And we'll also want to know any other assumptions that you made as part of the savings calculation. And then the second main thing we will want to see is the useful life. And we've already walked through what that calculation looks like, but it is something that we view as a key outcome from your analysis. You are welcome to present your savings analysis in any form that you'd like. We don't have a standard template for how you should submit it to us. But what we will ask is that we do have a standardized one-page summary table that will need to be filled out. And you can see right here an example of what one of those looks like. Essentially, we're just breaking the project down by measure and including all of the associated savings and cost for each measure. This table is going to go to the third-party reviewer ultimately that the ITPR will sign off on it. And it's so that we are just very clear on what is being claimed in terms of savings for each of our projects and standardizing how that information is displayed across all of our projects. Ultimately, all of our projects are going to be evaluated on their economic merits. And in the PACE world, not just in Texas, but really the entire country, uses a metric called the Savings to Investment Ratio, or SIR. The math behind calculating the SIR is fairly simple, fairly straightforward. We will sum the total of the savings over the life of the assessment, and that'll go on the top part of the ratio. On the bottom part goes the investment, where we will sum the total cost of the project over the life of the assessment, including financing cost. The inputs to the SIR are in dollars, and everything is non-discounted, so nominal dollars. We previously discussed what you could count as savings, but we also need to discuss what you should count on the investment side of the ratio. And the principle is fairly similar to the one from savings. If there is a cost incurred as a result of doing the project, you should count that under the investment side. The most obvious one and the largest one is going to be the financing cost, so the annual payment, both principal and interest, that goes into the PACE financing. Beyond that, if there's any additional capital expense due to the project, that should also be counted as investment. For example, with a solar project, if there needs to be an inverter replacement after 15 years or so, that should be accounted for. For an LED project, if the bulbs will need to be replaced at some point during the life of the project, that will need to be accounted for. And finally, you also need to account for any maintenance expenses. The ones we see most commonly are if there's some type of cleaning expense, for example, for solar panels. I want to give an example of an SIR calculation, and for this example, let's go back to our HVAC and LED lighting project. In this project, we have an HVAC system which is going to save $50,000 a year for 20 years, and we have an LED system which is going to save $20,000 a year for 10 years. Let's assume that the annual payment on that project is $50,000 a year. That is including principal and interest. The SIR calculation looks just like this. We take the HVAC system, $50,000 a year times 18 years. Now, why did I use 18 years? Because as you might recall, our useful life of this blended project was 18.3 years, so that represented the maximum length of the assessment. So for this example, let's assume that the assessment lasted 18 years. So that's our HVAC. Our LED savings were calculated by $20,000 a year times 10 years that its useful life is going to last. That's the top of our ratio. And then on the bottom is the cost. The annual payment, $50,000 a year, times the 18 years that the payment will be made. When you do the math, you do the multiplying, the adding, dividing, you end up with $1.1 million on top, and on the bottom of the ratio, $900,000. And that leaves us with an SIR of 1.22, which is greater than the 1 that we're looking for. In effect, this project will save more over its life than it cost. Anybody that's done any modeling knows that the results you get from your model will only be as good as the assumptions that went into the model. And what we'll do for all of our projects is we will take your baseline and your savings analysis, and we will run it through an internal analysis, internal to TPA, to Texas Pace Authority, and we'll corroborate the results you got in terms of the SIR. Generally, we will use, there's some pretty common modeling assumptions. For example, typically we'll allow utility escalation rates of about 2%. We'll do a savings degradation of about 1%. The typical solar production decrease I've seen is about 0.5%. Really, for any of your projects, if you have a question on what assumptions you think are appropriate for your particular project, please ask us and we can help you out with an answer there.